Right, welcome everyone to the first Rosecut market update of 2022. I'm joined by Mike. Happy New Year to you,
Daniel,
Mike.
Happy New Year to you too. Yeah, a bit of a jumpy start to the year, I guess.
Yes, I think we've just hit correction territory in the NASDAQ, down about 10%. There's that and inflation that I think we should touch upon today. Shall we start with the NASDAQ and what's going on below the surface there?
Let's do the NASDAQ. And I guess to start, a lot of the kind of the growth, techie innovation stocks have been under pressure for the last couple of months. If you think of headline stocks like PayPal, for example, Palantir, and then it's really only recently that the headline index plus some of the really big stocks like Apple, Microsoft have come under pressure. And it's really all got to do with valuations and bond yields. Typically, higher bond yields mean that the valuation for tech stocks tends to be more demanding. From the very start of the year, we saw a sharp rise in bond yields from about 1.5% to 1.8%. And that in the last week or so has led to quite a sell-off in the NASDAQ itself.
Yes, I think a lot of people don't realise as well what's going on underneath the surface of these indices, because there's a lot of very speculative tech names that are almost in a sort of mini .com crash. So what I mean by that is companies like Zoom, and we're recording on Zoom right now, they were very bid during 2020. So they went up an awful lot. And since they peaked, they're now down. Zoom's down about 70%.
Yep.
And there's no obvious group of investors that's going to step in just yet. Because if they're trading at, say, 35 times as a price to earnings ratio, that's too expensive for value investors to get involved right now. Momentum investors are not going to be touching it. And growth investors are already feeling some pain and probably maxed out. So it wouldn't surprise me if some of these tech companies continue to fall, even if the headline index is only down 10% or so.
Yeah, it's been quite a tough time for growth investors. And I think what we need to see is calming of fears around inflation, around rising bond yields, and a sense then that growth is going to pick up again as we get through all of the noise associated with COVID and supply chain disruptions as well. And I guess one of the things that figures quite prominently here is inflation, which has just looking at headline indices, the OECD have an inflation measure that tracks inflation across the OECD countries. That's hit, I think, a multi-decade, 3-decade high in the last couple of days. We're awaiting, as we speak, CPI data in the US. We've seen inflation hit, 6% or more in Germany. So this is new. We haven't seen this in quite some time. And I think for clients of Rosecut, again, it's something to factor into portfolios in terms of how we play it and how we adjust the portfolio around this.
Yeah, and there's a lot we could talk about with inflation, really, isn't there? The Federal Reserve, which is the US central bank, they released their minutes from the December meeting, just at the start of the year. And that was what led to this sell-off in bond yields. I think it was one of the worst couple of days in the bond market for a number of years, and quite a large move for bonds as well. The question that everybody's wondering is whether inflation is transitory or not, and what exactly transitory means. My view, for what it's worth, is that the Federal Reserve struggled to create inflation for 10 years. They wanted to, but they really struggled. And I don't think they figured it out this time. I think what's really caused a lot of this inflation is the fiscal stimulus we saw over the last couple of years. And as that runs off, particularly towards the second half of this year, inflation will start to fall back down due to structural forces that are out there. So demographics, lack of a unionised workforce, etc. In which case, I suspect that if bond yields continue to rise, there could actually be an interesting opportunity to add some more bond exposure.
Yeah, I think so. At the moment, we're in the middle of a squeeze lower in bond price because there is this confusion as to whether inflation is temporary or not. And certainly there are some parts worth watching wage price inflation to see if there is a sort of temporary underlying trend. But I think if you take out base effects, particularly in commodity prices, if you factor out supply chain disruptions, a lot of the extreme moves in inflation numbers would probably go the other way, or at least flatten out in the next couple of months, which I think will be good for bond markets, and maybe within equities, maybe good for some of these tech stocks again.
Yeah, and it'll help the Federal Reserve as well, because a lot of their credibility is called.
Exactly, yeah.
It is questioned, shall we say, and this year is midterm elections towards the end of the year in the US, so they will want to come across as doing something about inflation.
Exactly.
And the reason I reference this actually is because I think right now the Fed is really trying to talk down inflation expectations before they become self-fulfilling and also ward off some of that political pressure. So that's what I think we can continue to hear about in the near term.
Yeah, so I think, just to sum up, I mean, in a way it's all about liquidity, and the liquidity tap depends on how markets and how the Federal Reserve are reading the inflation numbers. I think bear in mind as well that markets have now priced in quite an aggressive move from the Fed for the rest of this year. So it may be that we're kind of within the next couple of weeks, we're hitting that point where people are being pessimistic about what the Fed is going to do, and that as a result of that, we begin to get some upside potential. Yeah,
I mean, we were talking just before we started, Mike, about what we call the terminal rate. So that's the highest rate we expect the Federal Reserve to raise base rates to within this economic cycle.
Yes, exactly. Yeah.
And 2.5% is what the market's expecting. A lot of smart commentators are speculating that it'll actually end up being more like 1.5%.
Yeah.
So if they do 75 basis points this year, we could be halfway done for the cycle already.
Yeah. And even if we just to finish, go back in time to when you had inflation like this, in the mid-90s, when the Fed raised rates and Fed funds were at 5+% for maybe 4 or 5 years until the dot-com recession, we most likely won't have that. The peak in rates will be much lower, partly because there's so much debt in the economy that you won't be able to sustain high rates like that without a big recession. That helps us to bound, I think, the impact and the level of monetary policy from the Federal Reserve.
Yep. Well, that was quite a good stint on inflation for us, I think, Mike. So let's see how markets move over next month, and look forward to chatting again in a month's time.
Okay, very good.